Understanding ICT liquidity is the most important concept when it comes to trading ICT, and that is why it's going to be the first video of this series. This video will be a foundation for you to understand ICT concepts and implement them into your style of trading. So without further ado, let's start it up. Now, before we even look at liquidity, we must look at market context. What do I mean by this? You should know how the market is currently moving. Are we currently in a bullish market or are we in a bearish market? You feel me? Or is it neither and price is just range bound? These questions should be asked before putting on a trade because they will help you form your ideas more clearly and get you in on the right side of the market. Now, you don't want to be on the wrong side of the market, you feel me? So you want to be asking yourself this question. Now, let's say we're in a bullish market, okay? Price is making higher highs right here. Price is making higher highs and higher lows right here, okay? Under each low rests liquidity, and also above each high rests liquidity. You might have not known that above each high rests liquidity even in a bullish market, but yes, even above each high there is liquidity. Why is that? Because shorts that got in on this move right here, they likely got in maybe over here and moved their stop up above this high, and on the next leg up they all get stopped out. Now, let's say someone got into this move since the very beginning and price forms new structure. Now, let's say they got in right here with the stop loss of whatever, all targeting all the way up here, okay? Do you think they're gonna have their initial stop loss with this market context? Likely not, okay? They got in right here. They don't want to be taking a loss on this remaining position, so they will likely move their stop to break even, and once price forms new structure, they're gonna move their stop loss below this structure, so then they get stopped for a profit on the trade. Now, think about it. A lot of these traders don't want to be putting a stop loss at break even when price makes new structure like this, okay? Let's say you're in this trade and you got in at these lows right here, okay? Let's say you're in profit $500 on this trade. With this market context, all of this, right? Would you place your stop at break even, or would you place your stop below these lows? If you say break even, you're lying, all right? Don't even talk to me, because you know if these lows break, your stop of break even will likely get hit. And also, if you're up $500 on the trade, do you want to be taking it off for break even, or do you want to be taking it off for profit? Right? You have to understand psychology of a lot of these other traders. They will likely want to be taking the position off for a profit instead of break even. Now, since so many people have their stop losses below previous structure, market makers and the people who move price, they know that, all right? Your stop loss is mad predictable. It's one dimensional. Come on, you're not doing anything right now, okay? So what they will do is they will bring price all the way down to your stop loss, so the person that got in on this position at the very beginning, their ass is stopped out, and then they create the next leg higher. All right, that is the most likely scenario for what market makers try to do with liquidity. Now, while your ass is getting stopped out, big money is accumulating positions right here, right below these lows for the next leg higher, because they know that so many stop loss orders are beneath these lows that their full position will get filled below these lows. For every buyer, there needs to be a seller. All right, and since yo ass is gonna be a seller down here, they're gonna be a buyer, and so many people are sellers down here because everyone trades so one-dimensionally that, bro, these fools, these market makers, they predict your ass like what do they predict you as? What's something that's super predictable? They predict you like a one block Rubik's Cube, all right? You're not doing anything right now with this stop loss. Now, you might be thinking, why would they need to bring price lower so they can fill their long positions? Firstly, big money is only able to get in on a move in areas of high liquidity, which are significant highs and significant lows. They are not getting in the middle of a move. Why? Because if they do, they will move price significantly to one direction. The only way for these fools to get filled full position close to where they want and where their limits are is in areas of high liquidity, which are these highs and lows, all right? Now that y'all know the basics, let's talk about some more advanced liquidity concepts and scenarios, okay? Now, let's say we're in a bearish market this time and price is making lower lows, lower highs, right? La-di-da-di-da. And at this low, we don't fully take out this low yet. Let's say it's a double bottom, right? Yo ass thinks it's a double bottom, and then we bounce right here. All right, it's not a strong enough bounce, and then price comes all the way down again. All right, price comes here and then bounces again, but this time taking out these these highs, okay? Now your ass is probably thinking, oh my god, yo, this is symmetrical triangle falling wedge breakout. No, okay? Your ass is probably thinking, yo, this is a market structure shift because we broke above this high right here. No, okay? You got to think about liquidity, all right? We have 3 lows right here, and what is resting below this? This is not a market structure shift. There's a chance price can go higher and we go up like that, but there's a higher chance that this right here was just a liquidity sweep, okay? And price, since there's even more liquidity below these lows right there, what price wants to do is actually take out these lows now, all right? Why is this, all right? Firstly, yo ass is probably thinking long before this move right here, okay? Yo ass thinks, all right, let's go long over here, so automatically your liquidity, okay? Secondly, every single long in this market has their stop below these lows, and a lot of the shorts that got in on this move were trailing their stops and they got taken out, right? So thinking like a market maker, what did they do? Filled their short positions up here, and now this is going to be their next leg lower, okay? Majority of retail and even y'all ICT SMC traders think that this is a market structure shift when that's what they want you to think. You are likely looking for longs right now, meanwhile big money is shorting, right? You are literally their liquidity, okay? We take out the highs, which means we take out the liquidity, and the likely scenario for us is to go down and take out these lows, whoopsie daisies, these lows where all this liquidity is resting. Keep in mind, this is the same scenario in a bullish market with relative highs, okay? All this liquidity, I want that. Alright, this is a message from the editor, and this scenario played out exactly the same today, okay? We have 2 tops right here, liquidity resting above this, okay? So easy liquidity, price moves lower, okay? Comes back a bit lower, comes back so close to taking out these highs, but we don't do that, and we quote unquote do that market structure shift that I just talked about, but it's not a real market structure shift because we have these highs that want to get taken out right here. We take out this liquidity, and what does price do? Goes higher to that higher time frame objective. Now in a bullish market, you want to be buying when price takes out a low right here, okay? We take out this low, shoot up higher, okay? And in a bearish market, you want to be selling when price is taking out a high, okay? That's your ideal scenario. If you are new to this concept, I highly recommend you do not try to short price when price is taking out a high in a bearish market right here. Don't be trying to short this, or even a low in a bearish market, okay? Don't be trying to do that if you're new to this concept. Now this is only for trending markets. What do you do in a sideways consolidation market? Literally, you just buy every single significant low created and you just short every single significant high created. Okay, like it's really not that hard. Like here's an example with the S&P 500. We're in a sideways consolidation snooze fest market, okay? What do? We buy a significant low created. Whoa, wait a minute. We take out this low and we shoot higher, okay? And we short a significant high created, okay? Significant high created over here, okay? Significant high created over here, okay? We just buy a significant low and short a significant high. It's a snooze fest, okay? I know it's easy, but like it's a snooze fest. Significant low created, buy that, significant high created, short that. Wow. Now with liquidity comes objectives, also known as draw on liquidity, and that will likely be another video. I don't want this one to be too long. I just want it to be short and easy to absorb, so I will not be talking about objectives on this, all right? So let's do some IRL examples with 2 scenarios, a bullish market and a bearish market, right? We'll literally zoom out, try to find a bullish market when price is making higher highs, higher lows. Boom. Okay, let's look at this. So we're in a bullish market. Firstly, how do we know we're in a bullish market? We take out these lows right here and we shift structure strongly, okay, right here. We shift structure. So this is your shift in structure, and we're kind of looking for bullish price action, okay? Let's see liquidity play out in real time, okay? Where is liquidity resting? Beneath these lows? beneath these lows. This is exactly the same scenario that I talked about. Price making higher highs, higher lows. Beneath these lows is liquidity. What's the most likely scenario that's going to happen? We take out these lows and shoot up higher. What happens? Let's go to the right. We take out these lows. Easy. Okay, and we move higher. Okay, from these lows we have a 100-point ripper. Bam. Okay, we're moving higher. All right, what happens now? Take out these lows, move higher. What happens now? There's liquidity here. All right, what happens now? Take out these lows, move higher. This is not a coincidence, the fact that we're taking out these lows and then we're moving higher after taking out those lows, because before every big move in the market, there has to be a liquidity sweep. Write that down. Before every big move in the market, there has to be a liquidity sweep, and that will add confidence on every single one of your setups. Why? Because you want to know that big money is in the same trade that you're in. Big money can't be in the same trade as you if there isn't a liquidity sweep. Think about it. Come on now. So we take out these highs and we move lower. We take out these lows literally by the tick. All right, you can see the low is 65.5 and this is 65. 2 ticks. We take this low out by 2 ticks and we move higher. Is that a coincidence? I don't think so. Now let's do the same thing in a bearish market, looking at the same chart. Okay, we take out these highs, move lower. We take out these highs, move lower. We take out these highs, move lower. Look how precise this is. Look at the high of this candle. The high is 41.03. The high of this candle is 41.03.75. 3 ticks. We take out this high by 3 ticks and move lower. And you think liquidity doesn't matter in this market? Come on now. Let's do some more. Let's do some more. We take out this high, move lower. Take out this high, move a little lower. Okay, let's keep going. Let's keep going. Now price is moving higher right here, and every single short that got in, let's say maybe a little later, let's say they got in right here. Oh, whoops. Let's say they got in right here, or whatever. They're trailing their stops up. Firstly, they get stopped right here, and the last people, they're getting stopped maybe like up here ish. Okay, guess what happens when price comes into this level? Price comes into this level, takes out all this liquidity, so every single short right here, they're all stopped out, and price moves lower. Price moves lower. We take out this high, price comes down. Okay, keep moving lower, lower, lower. Take out this high, price comes down. What else? Take out this high, price comes down. Like, it's getting a little too easy to spot at this point, right? Like, take out this high, price comes down. Also these London highs right here, price takes out this high, moves lower. Price takes out this high, moves lower. This high as well, significant high, moves lower. Like, it's getting too easy. Takes out that high, moves lower. Like, come on now. Like, relative equal highs, double top, or yeah, people think that, oh, this is a double top, let me short this. Get that ass smoked. Take out this high, move lower. You must realize that before any big move in the market, liquidity must be taken out for big money to enter the marketplace. Okay, always keep that in mind. And with all that being said, I think that is enough for one video. I don't want to make this too long and have y'all snoozing by the end of it. So thank you so much for watching till the end of the video. If you have any questions regarding liquidity or don't understand the concept, leave a comment down below. I'd be happy to help. Follow my Twitter to see my journey in real time and see some trade ideas that I put out from time to time, or even if you want to talk to me on a one-on-one basis, my Twitter is the way to go with that. Subscribe if you're new and want to learn more about ICT, smart money concept, style of trading. Like the video if you learned something new, and I'll catch y'all next time.